has the Andrews government single-handedly screwed the Melbourne property market. We have been locked down for almost 6 months now, and this gives us the title of the longest lockdown in the world. In today's video, we are going to look at how this extensive lockdown has affected the Melbourne property market and the local economy. Hey guys, welcome back to the channel. If you haven't already, please like and subscribe. You'll be doing me a huge favor, so I can keep bringing out content just like this for you guys. Now, let's get straight into it. I'll be breaking this video down into 3 parts. The first part will discuss how this lockdown has affected the Melbourne economy and give you guys some pretty concerning data to see just how bad the damage is. And in part 2, we are going to look at how this lockdown has affected the Melbourne property market, which parts of the market are performing better than others, and which parts of the market that we should be avoiding at all costs. And in part 3, we are going to discuss the future of the Melbourne property market, which parts of the market are going to recover the quickest, and which parts of the market are likely to have a longer recovery, and which areas we should be looking at to invest our money for the best growth in the coming years. When this pandemic started in March, the government was very quick to act. We went swiftly into a lockdown, and we ultimately became the envy of the nation as well as the world with our low case numbers. So we have to ask ourselves, what the hell happened? How did all of this hard work turn into such an extensive and long second lockdown? Without pointing any fingers and using the facts that have been made known to the public, it is pretty obvious what has happened in the last few months. Most recent cases can be traced all the way back to the hotel quarantine breaches. This is not a political video, so we won't go into too much detail about this. But Victoria was one of the only states to refuse assistance from the Defence Force personnel, and the job to guard the quarantine hotels were instead given to a private company who would go on to hire individuals who would then facilitate multiple breaches. With the results of the hotel quarantine inquiry to be released in the coming weeks, I'm sure we will get a better understanding of exactly who is at fault and who is to blame for this mess that we are in right now. That is all I will say about the topic. It has honestly been a very frustrating few months for me, being stuck at home and not being able to go outside while all the other states are well on the road to recovery. Now, let's take a look at how this extensive lockdown has affected the Melbourne economy. Before the second lockdown commenced, around 15% of small businesses said they will be shutting their doors for the final time. This is very concerning because that survey was conducted in July. It has now been 2 long months, and this lockdown has honestly gone for a lot longer than most of us have expected. This means that the 15% of businesses will now likely be something much higher. This will have a very bad flow-on effect for the rest of the economy, and this will be felt by many other businesses going forward. This will likely lead to a very slow recovery, and without extensive government support and stimulus, the remaining businesses are also going to struggle because people are just not going to spend money like they used to. I recently came across this article, and this article is very concerning. This article says that Melbourne CBD could turn into a wasteland and a complete ghost town because of the massive business closures. Consumer confidence is also at an all-time low, with 42% of Aussies now looking at ways to save money and reduce their weekly expenses. And more consumers are now making shopping lists to cut out unnecessary expenses. This graph shows that consumers are also making changes to their spending habits, and around 1/3 of Australians are cutting back on spending and purchases. All of this data paints a very grim picture and suggests a very slow recovery ahead. Now that we have a better understanding of the devastation caused by the second lockdown, let's go into part 2 and see how the Melbourne property market is performing. Let's start by looking at the home prices for the Australian capital cities. If we look at this graph provided by CoreLogic, we can see that Melbourne saw a drop of 1.2% in the month of August, while Sydney and Brisbane saw a small drop compared to previous periods, and the house prices in the other states all stayed steady or increased slightly. This information tells us a few things. 1. With lockdown and restrictions easing in most of the countries, those markets are starting to stabilize or recover. However, with Melbourne still in stage 4, the home prices continue to fall. This will suggest that Melbourne will see another big drop when the September data is released. And the longer we stay in lockdown for, the worse things will get. I personally believe that it is completely possible for us to remain in lockdown under harsh conditions for another month or 2. And what we need to understand here is that even when we do come out of lockdown, consumer confidence will still be at all-time low. this means that house prices could continue to fall. While the performance of the property market can be very hard to predict, the Melbourne property market will definitely be much worse than the other states due to just how long we have been in lockdown for. Another thing that we can take away from this data is Australia's most expensive cities are feeling the most stress. And this will make a lot of sense because Melbourne and Sydney have been going up in such crazy rates in the last decade. A lot of homeowners and investors have stretched themselves financially to buy or invest into these markets. With such low rental returns and the vacancy rate slowly creeping up, investors are really starting to feel the stress of their negative geared properties. Even with record low interest rates, homeowners are also starting to feel the stress of their high repayments. While the house prices in Melbourne have decreased overall, there are some parts of the market that are performing a lot better than others. So let's take a look into that. So let's start with the elephant in the room, the Melbourne CBD market. Even before March, the Melbourne CBD apartment market has been oversupplied for many years. This means that there has been more apartments built than people are willing to buy. However, with the rise of Airbnb, overseas investors and international students, some of that excess supply has been somewhat absorbed. But with our borders closed, migration has completely stopped. Some international students are opting to go back home and wait for all of this to blow over, and all the Airbnb apartments are now back on the market because there is no tourism in Australia right now. As a result of years of oversupply and the closure of our borders, vacancy rates in the postcode 3000 has more than doubled from 4% to 10%. The hardest hit postcode is 3008. The vacancy rate of Docklands has quadrupled from 3.7% to 16%. When we look at the Melbourne CBD from afar, all we can see are cranes and apartments. This shows that there are many more apartments being built, and in the next 6 to 12 months, we are going to see all of those apartments come onto the market to compete with the existing properties. This is likely to lead to higher vacancy rates and the price of apartments dropping even further. With more than 50% of apartments being owned by investors, we are likely to see some selling pressures going ahead as investors decide that they can no longer hold apartments with such low rental returns and high vacancy rates. And all of this is very concerning. So if you're looking to invest in the Melbourne CBD market, I would really think twice and wait for things to get a bit better before putting your money into such an overpriced and oversupplied market. Now let's move on to the higher end of the market. Believe it or not, despite all the craziness that has been going on in the last few months, Melbourne has registered 24 new $1 million suburbs. This brings the total to 119 suburbs with an average price exceeding the $1 million mark. While this is incredible, there are a few factors that we must take into consideration. 1. The government stimulus and bank repayment holidays. These no doubt have contributed to this, and we will get a more clear picture of what's going on in the coming months when the repayment holidays end. Another factor we need to consider is the low number of listings. With the current uncertainty in the market and repayment holidays, sellers have no incentive to sell. And with record low interest rates, enough demand has been generated to absorb new listings. As we can see here, despite everything that has happened this year, dwelling value in Melbourne is still up 4.9% from this time last year. After the Royal Commission inquiry concluded, house prices were starting to go back up and a lot of people bought into the market just before March. While a lot of homeowners in these blue chip suburbs are high net worth individuals and have largely been unaffected by the recent layoffs, those who have stretched themselves financially to buy or invest into these blue chip suburbs could face difficulties in the future when the repayment holidays end. This includes households with high combined incomes who had no problem servicing their mortgage prior to March, but have since been made redundant, or successful small business owners who could no longer stay afloat during this prolonged lockdown. The extent of the stress going forward really depends on how much longer we stay in this lockdown for, and how much more support we get from the governments. The longer we stay in lockdown for, the worse things are. The quicker we get out of it, the quicker we can start our road to recovery. Now, let's move on to the more affordable section of the market. According to a recent report, the upper quartile of Melbourne's housing market dropped by around 7% since March, while the lower quartile only dropped by a modest 1.7%. I think this is pretty much spot on. Melbourne home prices were increasing dramatically leading up to March, and when the lockdown began, this trend reversed. However, with the introduction of the Home Builder Scheme and the First Home Loan Deposit Scheme, first home owners were finally given the chance to enter the property market in this low interest environment. First homeowners were allowed to enter the market with only a 5% deposit, and they were well incentivized to, with various grants giving them even more purchasing power. As a result, the lower end of the market actually took off. Home and land packages were becoming super popular, and properties in the sub 500k range saw a lot of competition. As most of you guys know, I have investment properties in Hobart, and I do keep a pretty close eye and monitor the market pretty closely. So to tell you guys something crazy, despite all the crazy growth that we have seen in Hobart in the last few years, it is still going absolutely crazy over there. There's a property that I was recently inquiring and talking to an agent about. It was a property in an area called Bridgewater, which was marketed for about 200k plus. So within the first 24 hours of that property coming onto the market, they got 9 offers and that property was sold within a day. And that shows what all the government stimulus and the low interest rates have done to some parts of the market. And I'm not only seeing that in Hobart, I'm seeing that in parts of Melbourne as well, with properties selling for way above reserve. And those properties are selling very quickly. However, it will be interesting to see what's happening in the market when the latest data is released. I believe there will be a decrease in even the more affordable areas of the market, with many buyers holding off due to all of this uncertainty. Alright guys, that was a lot of data. I hope you guys were able to make sense of all of that. Now let's put all of those data together and try to make sense of what's happening right now and to see if there's any opportunities going forward. As we discussed, the Melbourne CBD market is doomed. Massive oversupply, high vacancy rates, decreasing rent yields, and I think that market should be avoided at all costs. Now let's talk about the more expensive houses in the blue chip suburbs. I think the properties in those sections of the market are going to struggle a little bit just because of the high levels of debt and the high repayments, as well as most properties in those markets being negatively geared, which also puts pressure on the investors and homeowners who now have to come up with extra money in these tough times to repay their mortgage. Now let's talk about the lower end of the property market. I think this is the market where we're going to see a lot of growth going forward in the next 6 to 12 months. With such low interest rates and high government stimulus and support for first home buyers, we are going to see a lot of pressure, upward pressure in those cheaper, more affordable areas as more and more home buyers now finally enter into the market. And they're going to drive up prices in those suburbs. And I think that is going to be where we should be putting our money going forward if we are to invest under these conditions. With that said, that is only my personal opinion based on my research. Our circumstances are completely different and our investment strategies are completely different as well. So I'll encourage you guys to do your own research and formulate your own personalized investment strategy. Alright guys, that brings us to the end of the video. If you liked the video, give me a thumbs up and consider subscribing. It will really help out the channel. If you didn't like the video, that's fine. Give me a thumbs down and tell me why you didn't like the videos. I think as property investors, the best thing we can do is to exchange information so we get a better understanding of what's going on out there. And yeah, I'd love to chat with you guys. Anyway, I'll see you guys next week.